But at this point, we're going to move on to our next presentation, and we're going to hear from Kemp Anderson and Timothy Jernigan. So Kemp Anderson, before starting his own consulting business, Kemp was a vice president of business development at Scott's Lawn Service, and he also has industry M&A experience with Rollins and Middleton Lawn and Pest. And Tim Jernigan is the senior vice president and portfolio management at Morgan Stanley. And in 16 years, Tim has risen through the ranks of the industry and has become a leader in financial services for high net worth individuals. Both Kemp and Tim are going to speak on the topic of post-transaction wealth management. So Tim and Kemp, take it away.
Brad, can you hear us?
Yeah, you're good to go, Kemp. Thanks.
Okay. All right, great. You want to go to the next slide? And first, just say thank you to PCT for doing this every year. It's absolutely a huge value to a lot of people in the industry. And also thank you to the listeners out there as well. What we're going to try to discuss today is certainly some of the wealth that can be created from owning a pest control company. A lot of people look past the amount of wealth that is generated over time, and also when you exit, also some of the steps that you want to take when you prepare to sell, a little high overview on the process itself, and again, the wealth creation as well.
And this is Tim Jernigan. So what I'll talk a little bit about is Morgan Stanley, our team, kind of Morgan Stanley, how we can help raise capital, and not only the acquisition, but also on the exit strategy as well. What makes Morgan Stanley different? And again, the process along the way. And I'll also touch a little bit about wealth management throughout the next 10, 15, 20 years of someone's life.
So if you want to go to the next slide. So one of the things that a lot of people think about when they sell, a lot of questions that we get is, how do I replace my income? How do I manage my income? When I started my firm, you know, the natural progression for me personally was to help people buy or sell. But what I was also able to do with the relationship with Tim and Morgan Stanley is also to introduce them to Tim and to Morgan, and whether they're looking for the potential to raise capital to grow while they own, or trust management, wealth management, and certainly management after the transaction. So all along the way, it's really a process. And hopefully today we can help people out with some of the clarity of that. So next slide, please. So this is an example, and this is kind of an interesting example. So this example says, what if I owned a company in 1996, and in 1996, I did approximately $500,000 in revenue with my pest control company. And between 1996 and 2016, I grew at about 7% a year. And every year, I had about 20% net. Now, certainly our businesses in the pest control industry are not this linear, but you'd be surprised at how stable the industry is. I think Dan spoke this morning when he opened the conference about, you know, the industry compounded annual growth of around 4.5–5%. So it's certainly not abnormal to see a pest control company with 7% growth and 20% net. So what that would translate to is in 2016, and I realize we're in the middle of 2017 now, but at the end of 2016, for this exercise, your business would actually have 1.9 million in revenue, hopefully recurring, and at 20% net, you would be at 395,000 per year in adjusted earnings, which is a lot of money. So next slide, please. So what that would really translate to is, over the 20 years, 1996 to 2016, the cumulative earnings in that example was $4.3 million. If you sold it in today's market, and we've heard a lot of people talk about how, I'm going to say, hot the industry is. If you had $2 million in recurring revenue, there's a massive amount of variables, but you could sell for $2 million, $3 million, even $4 million. So the total earnings, if you sold today and you started back in 1996, you could have accumulated over $8.3 million in total earnings. This is an example. This is what can happen, but what's powerful is to look at the wealth that is generated from a pest control company over time. This is why certainly the bigger companies, the Orkins, the Rentokils, the Arrows, the Masseys, the Terminixes of the world have continued to stay in our business, to stay in our industry, because it generates a lot of wealth, whether you're $1 million or $2 million in revenue, or whether you're $1 billion company or anybody in between. Over time, it will generate, if run properly, and again, there's a lot of variables, but if run properly, our businesses in the pest control industry will generate massive amounts of wealth. So next slide, please. So what's involved? If you've been in the business 20, 25, 30 years, maybe more, maybe a little bit less, and you're saying, you know, the market's hot, certainly the multiples are high. If I've done a great job and I have a great team and I have all the right processes in place, maybe it's the time to sell. A lot of times I will tell you that one of the bigger mistakes that people make is they don't necessarily prepare to sell. What does that mean? Again, you know, for example, are you a drug-free workplace? That actually matters. That adds value. Do you have GPS tracking on your trucks? What kind of software do you use? Do you have agreements? Are you recurring? What are the service lines? There's a lot of things that go into preparing to sell. Have you worked with your CPA? How does your P&L and balance sheet look like, and tax returns, and so on and so on and so on? Do you have a team? A lot of companies, large and small, don't necessarily have an M&A team, which would be, you know, a CPA, an acquisition attorney, somebody like me that can help you through the process, and then somebody like Tim, who's either been involved or is now getting involved to prepare for this infusion of wealth on the transaction. And then you really have to execute, and it is a process, getting ready to sell, finding the right buyers, preparing to sell, and then going through negotiations, going through due diligence, and a lot of people today have touched on integration as well. So to maximize the value, it takes time, and it is very much a process. So preparation is key. Next slide, please. So again, as we go back and we look at the wealth management in my example, again, from 96 to 06, if you started with 500,000 in revenue, you grew at about 7%, you were in that 20% net range. Again, upon the sale, depending on the multiple and a lot of variables, you could certainly be looking at, you know, north of 7, maybe even north of $8 million in total created wealth over time. So there's a lot of things that I think somebody like Tim can educate and help people with in our industry, including even going back to, well, I'm not ready to grow right now, or I'm not ready to sell right now, but I'm in a growth phase and I might need capital. Can Morgan Stanley help me with that? How is Morgan Stanley different? Again, am I working with the right tax people? Are my finances not only corporate and business wise, but also personally, is everything prepared for this process? So, and then ultimately, how do you invest, either before you sell or after you sell? Going back to that initial quote with Warren Buffett, if you had a chance to look at that, you know, certainly somebody with his experience, you look at that portfolio and there's a lot of diversification in there. So with that said, I'm thrilled to introduce somebody that I've worked with for a long time and who's now done some work inside the pest control industry for some corporations in our industry and for some entrepreneurs as well. And with that said, I'm going to turn it over to Tim Jernigan. So next slide, please.
Thank you, Kemp. Let me start by saying thank you to you as well, the PCT and listeners. I appreciate the opportunity to be on this call. And I can tell you, as I become more knowledgeable about this industry, the PCO industry, I realize every day that I am in the wrong business. As much as I appreciate the niche within the pest control industry, I see opportunities in this business that amaze me if done correctly, and that's the right thing, if it's done correctly. I believe those who work hard and those of you who have a great business model for acquisition can become very wealthy. And you can provide a family, a niche for your family and some wealth for your family like few others can. So let me start a little bit by talking about our firm, Morgan Stanley, and who we are. So let's go to the next slide. We are the largest firm on Wall Street with about $2 trillion in client assets. We work with individuals, we work with families, foundations, institutions, and small business owners like you. As you know, a lot of business owners work with traditional or what I would call neighborhood banks. And quite frankly, they don't recognize there's a difference between their local bank and the power and strength behind Morgan Stanley. Like your bank, we can help raise capital to grow your business, but we can also do this and align ourselves with the business owners as well as the consultants, i.e. Kemp Anderson Consulting. And we do this through all the phases of your life, even through the phases of your business. And that's your mergers, acquisitions, restructurings, exit strategies, and so on. So let's go to the next slide, talk about our global footprint. Not only are we one of the largest firms, but we also have one of the most recognizable names, and we are a very well-established business with over 80 years of experience. We have global footprints in about 1,200 offices around the world. Next slide. We'll talk a little bit about our team. So we talked a little bit about our firm. Here's a little bit of background about our team. As Kemp said, my name is Tim Jernigan. I'm a Senior Vice President and Wealth Advisor. And in my bio, you'll notice a quote that says, next to one's financial health, financial planning is one of the most important matters in one's life. And our purpose is to take care of our clients in a first-class way. We believe unaided, without help, mistakes can happen. Often, our job is as much about navigating the pitfalls as much as it is about creating one's or growing one's wealth. So just like there's pitfalls and mistakes that can happen when you buy or sell a business if unaided, we need help. I will ask our clients oftentimes who are retiring, how many times have you planned for retirement in your life? And they'll say, once, this is it. Well, I always say Morgan Stanley has helped thousands of clients retire, and we know the potential mistakes or pitfalls that can happen in that process. So the question I ask you is, how many times have you bought or sold a business? Maybe aligning yourself with someone with experience in that area can be one of the largest business assets you can make. Next slide. I have 3 assistants on my team, but I also have this group of 8 specialists in my office. So for example, for business owners, we may work with our private banker named Mike Fernandez there at the top when it comes to lending. Also as an example, maybe during a sale of a business, we would bring in Ray Galt or maybe Bill Burnett, who are our estate planning and trust specialists, to offer asset protection and maybe trust work for the family. Next slide. So let's talk a little bit about raising capital while owning your business and what makes Morgan Stanley different. Next slide. Number 1 is we are not a bank. Let me stress that again. We're not a bank, and that is big. And why is that big? Because we are not restricted by banking regulations. We don't have to conform to SBA rules, which often means our lending process is not so arduous or laborious or difficult. Anyone who's tried to establish an SBA loan understands what I'm talking about. We also offer different solutions depending on your needs. Something called an SBL loan, a security-based line of credit, offering checkbook access when capital is needed rather quickly. In other words, you don't have to make payments on the loan until you're ready to pull the trigger. It operates pretty much like the home equity line in your house. You establish the line, it's there. If you need access, you can either wire the money or use a checkbook. We also offer for our larger PCO clients tailored lending solution. Now this may mean that they're using their commercial property, their homes, boats. If they have planes, securities, we can use all that as collateral. We can come up with some larger money. And thirdly, if Morgan Stanley is not able to be a viable solution, we just don't like saying no. we'd rather refer you to one of our partnering firms who we have great relationships with. These firms work a little bit differently than your local bank. They are not restrictive, and they don't have those covenants often required by banks, meaning they can do everything in-house, right? They can do everything in-house. They are their own underwriters. They service their own loans. The closing costs are oftentimes not as high, and most importantly for business owners, they have longer amortization schedules, which means, most importantly for the business owners, the monthly payments are lower, which does not obstruct your everyday cash flow. So here are a few examples of capital raised for the clients of Kemp Anderson Consulting. Most recently, we helped a $10 million client with access to that $10 million via a checkbook. So with that, there's no closing costs on that loan. Simple interest is paid. It's not an amortized loan. And most of all, should the client want to eliminate that debt, there's no prepayment penalty. We met with another PCO with $1 million in free capital in case he wants to find a business. Again, no closing cost, no prepayment penalty, simple interest, and the available turnaround to get that loan in process should take about 2 weeks. Next slide. In the pest control industry, it's difficult to borrow against banks. We all know that. You don't have a plant, property, equipment. Go ahead and go to the next slide. And so if you don't have that plant, property, or equipment, the acquisition phase can be difficult. I said that. I actually went one slide more, so if you can go back. Yeah, there. I'll just talk a little bit about this. So let me say this, and I'll go on to the next slide. Because Morgan Stanley has started working with the PCOs, we've kind of created a little niche. So the beauty of this is that Kemp has brought a number of clients to us. We have vetted this industry. We know about goodwill. We lend on goodwill. Although there was some headaches at first, we think we've gotten through that, and we can now lend. We're more comfortable in doing it, and I will credit Kemp Anderson for the education of our firm. He did a lot of the legwork, which makes it much more easy from this point on. So now we'll go to the next slide and talk about customized wealth management process. So let's talk about long-term planning. This is an important slide. We all know, thanks to advanced medicine, we're living longer lives, right? We probably know somebody in our own household or our own family that's 90 years old. Jerry Lewis recently died at 91 years old. Don Rickles just died at 90. So people who are 65 years old today have a very good chance of seeing the ages of 80 or 90. In fact, a 65-year-old couple might be surprised to learn that at least one of them has a 50% probability of living another 25 years and needing investments to last until their 90th age. So bottom line, we're all living longer lives. We should plan for it. Next slide. That means Social Security just won't cut it. In other words, you'll need income replacement after the sale of your business. In this graph, we just show a household of $150,000 of pre-retirement income can expect in retirement about $40,500 coming from Social Security. What that means to me is we need to help fund another $100,000. Next slide. Oh, and by the way, that matters before you calculate how friendly your state is when it comes to retirement. Not all states are alike. Some states are more tax friendly than other states when it comes to retirement. We can help calculate your federal, your state, your local taxes, and its effect on your overall retirement goals. Next slide. So I'm often quoted to clients when I say clients can't eat pre-tax returns. And what I mean by that is investors today pay very little attention to taxes, but focus more on fees and performance. By far, the largest expense you will ever pay on your investments is taxes. Now, I'm not saying don't focus on fees and performance. I'm just saying taxes is so much greater. This graph simply shows how a tax-deferred account grows so much faster than a taxable account with the same amount of money growing at the same rate over a certain number of years, 30 years. Next slide. Obviously, wealth management is very important when you own and operate a business, but what about when you sell a business? So let's go to the next slide. Obviously, planning doesn't stop here. We help to identify unique family positions. What is your risk appetite? What's your time horizon? What type of liquidity needs do you have? Do you have any special needs? such as maybe a prior marriage, a special needs child, a pending lawsuit. Perhaps you had a horrible experience in the stock market and you would prefer a 5 or 6% guaranteed stream of income in retirement to help supplement your Social Security with no market risk. Others may be willing to accept a little bit more risk in hopes of a greater return. We can help build out that plan. Next slide. So in essence, Morgan Stanley assists in all aspects of wealth, even your day-to-day needs. In this chart, we show some of our services offered. For example, a small PCO may focus on lending solutions during their growth business, as well as wealth management and retirement solutions. Those may be very important. But then maybe trust and estate planning either before or during the sale of their business. And that's when they get that large sum of money that they want to secure. Next slide. What I will tell you, and I'll kind of echo what Kemp said in his slide, but through my experience, I can tell you emphatically that those PCOs who use a collaborative approach have a higher success rate than those who don't. And what I mean by that is if you are a partner, if you are partnering with a financial advisor, with a business consultant, i.e. Kemp Anderson Consulting, plus your local CPA and your local attorney, you will have a higher probability of success than those who try to go at it alone. Next slide. So, regardless of how much money you have, whether it's $1 million or $100 million, believe it or not, all investors, regardless of your size, have the same goals. Even people who have $100 million want to educate their kids, want to plan for retirement. They want to pay as little as they can in taxes. And so we offer a wider range of solutions for asset management, guaranteed income, insurance, lending, college planning, asset protection, and so on. So all of the stages of your wealth we can help prepare for. Next slide. So if you remember, thanks to advanced medicine and healthier lifestyles, we are all living a little bit longer. Can we go to the next slide? I'm sorry, one more. There we go. So I showed you this a moment ago. The new paradigm, I think, has shifted a little bit, especially since we don't truly know the future of Social Security benefits. And of course, fixed income is offering little to no returns today. I'll give you a little bit of a background here on this slide. Social Security was never meant to fund a full retirement. Clients used to retire at 65, 66, and unfortunately used to die in their early 70s. What really is troublesome or is creating a big conversations in our industry is people are living 30 years now in retirement. And so we have to be prepared for that. And what used to you could get by laddering some bonds and getting 4 or 5 or 6 or 7%. If you remember back in the 80s, your mortgage rate was probably 10, 15%. Now, fixed income offers no return. So we have to be prepared for that because fixed income isn't offering any yield, and because people are living 30 years in retirement, we have to allocate our portfolio a little bit more. So let's go to the next slide. I'm going to spend a little bit more detail on some of these slides because I think they're very important. If you're like many PCOs, you probably are sitting on a mountain of cash. So let me be the first to share what I would call bad news with you. If this is you, you are making a conscious decision to lose money over time. With interest rates near historic lows, cash just doesn't pay against inflation. Let's look at this example in the top left box. A $100,000 investment into a 6-month CD 10 years ago used to pay you about $5,240 of annual income. Today, look at it, $370. There's no such thing as a risk-free asset any longer. You have to diversify. And if you think today people sitting in cash are not sitting in cash, look at the bottom left of that graph there. There's more in cash today on the sidelines, missing one of the best bull markets we've experienced in our entire lifetime. More than $12 trillion in cash. Investors often think cash is a safe haven during volatile markets, but in an era of ultra low interest rates, I will tell you it's undermining the long-term investment objectives you may have. We have to move people out of cash earning 0%. Let's go to the next slide. Again, this is another really important slide I want to spend some time on. So you have to avoid emotional biases. Why? So we know you can invest in a lot of things when you diversify. You can invest in real estate, stocks, bonds, gold, etc. The average millionaire has about 7 sources of income, not just one. And you can't be emotional about it. Stick with a plan. So this graph shows you how each asset class has performed over the last 20 years. Real estate, which is the left column there that says REITs, has averaged the highest, which is about 11% per year over the last 20 years. What was the worst performing asset class on this chart highlighted in the bottom right in orange? The average investor. Why? Why is that? Well, if real estate, stocks, bonds, gold, oil, even inflation have all performed better than the average investor, there has to be a reason why. And I'm going to tell you. It's because the average investor lets emotion dictate their asset allocation. Next slide. So here's a surprise for you. All investments can be volatile, even fixed income. This chart actually shows you the S&P 500 over the last 37 years. So remember, let me remind you, the S&P 500 is made up of the biggest and supposedly best companies in America, the biggest and best 500 companies. That's companies like Pepsi, Walmart, Procter & Gamble, UPS, Apple. So although these companies are great companies, they do go up and down throughout a year. Clients often ask me, Tim, do you think the markets can drop 10%? My answer, of course, is yes. On average, this slide shows us the S&P drops about 14% every 10 months, and that's highlighted in the red dot there. So those intra-year market declines highlighted in the red dots there is for the S&P 500 each year dating back to 1980, right? So I always tell people, just don't let volatility scare you. Markets go up and down. The last time we had a 14% decline, I believe was February of last year, so we're overdue right now. But I think the markets fell about 12%, I believe, in February of last year, so it's very common. But here's the most important thing. In 28 of the 37 years on this graph, the S&P 500 still finished positive, with an average rate of return close to 9%. So let me repeat this. Volatility is normal. Markets do go down. I'm often criticized that every time the markets go down 10%, I'll call my clients and say, if you have available cash, now is the time to invest it. Clients always say, Tim, every time the markets go down, you think it's a great time to invest. I will tell you, there's only one time in my lifetime of 17 years now of doing this that I told clients not to invest. Do you care to guess what year that was? 2008. And the reason why was because earnings were falling about 50%. And stock prices follow earnings, not politics. So when earnings fall, stock prices fall. So I always tell people, just because Trump may be on television or they're talking about North Korea or Antifa or ISIS, that does not drive stock returns. Stock returns are driven on companies making money. A couple of years ago, Russia was invading Ukraine, and people called and wanted to sell Apple. And I thought, what do you think the effects it has on Apple that Russia is invading Ukraine? We can see it had none. Okay, let's go to the next slide. Staying invested matters. So another question I get is, Tim, I think the market's going down. Let's sell now and let's buy back in when the markets get low. I always tell clients that timing is very dangerous. Why? Because you have to be right twice. You need to know when to get out and when to buy back in. So this slide shows you a $10,000 investment in 1997 to 2016, or 20 years. The S&P averaged 7.68%. So a $10,000 investment, had you stayed investment and not sold, would be worth $44,000 today. But had you missed the 10 best days over that entire 20 years, your return dropped to 4%. Had you missed the 30 best days, well, now you have a negative return. So this is why investors historically have performed so poorly in the markets. They let emotion get in the way and drive their asset allocation. So I advise you stay invested and turn off the TV. All right? Next slide. So let's take it one step further. What about if you had a balanced account, 50% stocks and 50% bonds? Well, over a 1-year period, I can't tell you what your return would be. Could be up, could be down. But I can tell you, you can take any 5-year rolling period and you would have an average return somewhere between 21% per year or a 1% per year return. In other words, never in a 5-year period, even during the worst of times, would a 50-50 balanced portfolio, which is highlighted in gray there, have a negative return. Next slide. So the amount of risk you take all depends on your appetite for risk as well as your time horizon. So this is kind of a bucket approach that people are not investing this way today. So what I would tell you is that if you need money within the 3 or 6 month time period, short period of time, you need to stay in cash. That's the far left bucket. If you have a 5 to 10 year, for example, time period, let's say you have a child going to college or you're buying a home, then you need medium amounts of risk. But if you have long-term goals, maybe retirement goals, you don't need that cash sitting idle on the sidelines. You have to get it invested. So align your investments with your goals and your time horizon. So oftentimes clients actually have all 3 of these types of goals. They need short-term money, they need money within the next 5 years, and then they need longer-term money for retirements. When what we do is we will align each of your asset buckets with each of your goals, and this will keep you invested much longer. Next slide, structuring a portfolio. So how do we do that? It all depends on your needs, your wants, and your wishes. If you need income today, then your investments will look entirely different than someone who needs money maybe 20 years from now. So we can help you build out that portfolio and that plan, which matches your goals for your overall retirement. So we're looking at retirement here. So in retirement, obviously you need certain monthly expenses every month, right? We need to eat, we need to pay our basic bills such as utilities, gas, phone, etc. For those everyday needs highlighted at the bottom there, those needs, we use low-risk assets to achieve that, such as bonds, pensions, annuities, Social Security, and so on. For your wants, which is the middle bucket, that means you can live without it, but you'd rather not. We can use stocks, REITs, managed futures, and so on. And then if you want to leave a legacy, that's the top box, meaning what if you want to leave money to your family, your kids, your heirs? Then we can use commodities, alternatives, and other things. So diversification works. The last slide I'll show you here is a pretty busy slide, but it's the most important slide I have if you want to switch to the next one. Again, if you can understand this slide, and I'm going to break it down for you, I can promise you that you will know more than 90% of investors out there today. So this slide represents every asset class you can invest in dating back over the last 15 years. So for example, this chart shows you commodities, fixed income, large cap stocks, and remember, large cap stocks is big company stocks like Walmart, ExxonMobil. It even shows you mid-sized companies, that's mid-cap stocks. Mid-cap stocks are stocks you've probably heard of before, companies like Chipotle, Brown & Brown, Aramark. International stocks, so those are stocks outside the United States like Europe and Japan. Emerging market stocks, that's another index we can invest in. That's Brazil, Russia, India, China. Those are the emerging economies. It even has real estate on there and cash. It has every asset you can invest in. And every asset is actually represented by a different color here. So I would ask you to pick any color you want to, and I'll give you some time to do this, and follow it across, starting at the left in 2002, going all the way to the right through 2016. And tell me if you can find any discernible pattern at all by picking one color. Well, I would submit that you cannot. You cannot. But here's what I would tell you. Let's look at the year 2008. So we all know this was a horrible year in the stock market, right? Housing market as well. This was the Great Depression of our lifetime, called the financial crisis. I'm using this just to exaggerate a point here. In 2008, it shows fixed income as a top performing asset class there, returning 5.20%. And that's kind of, I don't know if that's blue or baby blue color. Now, in that same year, in 2008, at the bottom, it shows the worst performing asset class in purple, which is the emerging markets, returning negative 53.20%. So here's what happens beginning of 2009. At the end of 2008, I'll tell our clients, so Mr. and Mrs. Client, we're going to sell, or we're going to trim some of our fixed income, which made money last year, and we're going to buy, with the proceeds, some of the emerging markets. And when I tell clients that, they look at me like I just lost my mind, and he or she will say, all right, wait, Tim, you want me to sell fixed income, which is doing well, and you want me to buy a loser? Why don't we do this? Let's sell our losers and buy our bonds. It's doing much better. Why reward a loser and punish the winner? So I remind our clients, remember, investing 101, the basics tell us buy low and sell high. If we do that, we are forced to sell some of our fixed income, which also means we're forced to buy some of our emerging markets. Well, what happened to emerging markets the next year in 2009? Emerging markets was a top performing asset class, returning 79%. What goes up will eventually go down. What goes down will eventually go up. Be prudent about your investment strategy and stay diversified. I always say it's kind of like eating peas on your plate when you're a little kid, right? You want to eat everything else, but when it comes to peas, you're forced to eat them. Your parents usually make you eat them. It's really difficult to buy emerging markets when it's down 53%. It's really difficult to buy a specific asset class that's down 2 or 3 years in a row. If you look at 2012, 13, 14, and 15, you can see where commodities were the worst performing asset class. So I don't necessarily say every year you have to buy the loser, but I will tell you that in 2012, 13, 14, 15, when commodities were doing so poorly, there was a reason, and we did not have our clients invest there. As you know, that's when we discovered fracking. We can get to a lot of oil. There's no more demand in oil like there used to be. So the point is you usually do that, but there are times where we will avoid that. By the way, if you'll also notice the white box here, which is labeled asset allocation, this means if you're diversified, meaning you own all of those assets, you're always going to remain in the middle. Never in this time span have you ever seen where the white asset allocation box represented the 3 worst asset classes. In fact, during those 15 years, it averaged a return of 6.9%, while the S&P returned 6.7. So let me repeat that. If you look on the right, it shows you at the top ANN, which stands for annualized return over those years. And if you notice, the asset allocation in white is averaged 6.9%, and just below that in the green is the S&P at 6.7%. Not only did we outperform the S&P 500, but we did it with about half the risk, or significantly less risk. So to close, I'll say this. Why Morgan Stanley? And we can go to the next slide if you don't mind. Why Morgan Stanley? We can help during each phase of your business cycle, whether that's accumulation phase through the distribution phase. We can raise capital all the way through your selling your business. We are safer than banks. We offer higher FDIC limits. Banks offer about $250,000 per person. We offer about $500,000 per person. And whether it's retirement planning, saving for college, minimizing taxes, asset protection, lending solutions, whatever it needs, we can help. So like Kemp Anderson Consulting, we have the experience, and experience matters. Leverage the intellectual capital around you, and you will win. Again, thanks for the opportunity. I appreciate the business, and I appreciate your time today.
Thank you, Brad. I know this was a little bit of a tougher subject, but certainly one that that we run into quite often, just by virtue of the wealth that our industry and certainly that the owners in our industry recognize. And hopefully this was helpful. As Tim said, over time, while you're owning it, as you're planning your exit, or when you actually do exit, it's awesome to have a team and a real good strategy, certainly around your wealth. So with that, if there's any questions, Tim and I are certainly happy to do our best.
We did get a couple questions here. Question is for Tim. Tim, you had mentioned that Kemp has kind of educated you on the pest control industry. And what is it that a company like Morgan Stanley likes about this industry, and what do you think are some of its prospects for the future?
Well, and I'll let Kemp speak to this as well, but I will tell you that, oftentimes when you're borrowing assets, they want to see some collateral, right? And it's very difficult for you guys to have collateral because you have a lot of goodwill. So when you approach a bank, especially someone trying to conform to the banking regulations, it just doesn't fit their box. So Kemp, having a long relationship with us, came to us to see if we could help. And we thought we could, because we think there's value in the accounts receivable and the goodwill. And so the more we did our due diligence, and again, credit to Kemp for educating those underwriters who work with us, we realized that there is value, there is opportunity here, and there is, repeated customers and good cash flow. And these businesses do operate pretty well over time. And so with that, I want to ask Kemp his opinions on that, because he's the one who really talks to our underwriters to be able to get this pushed through. And once you do 2 or 3 of them, we go back to the same people. They kind of know the business, and so it makes it a bit easier. But like I said, I'll credit Kemp to that.
Brad, in the last couple years, Morgan Stanley sort of rolled up their sleeves, and we've worked with a handful of pest control owners, and we've done a couple things. One is certainly help them raise capital for growth, and then the other, with Tim's expertise, is certainly as well the wealth management side of it. What's really important is a lot of people out there on the phone or listening to the conference who either have tried to raise capital or gone to their banks even, and even if they have millions of dollars with that bank, the banks are still a little bit shy in dealing with our industry, whether it's to acquire another company, or let's say, even as an example, it may be to get an entirely new fleet, which could be a very expensive thing as well. And the banks are saying, where's the assets, and how do I value this business? And Morgan Stanley certainly, having the experience and the team that they have here, was able to say, okay, we get this. This business, the value of a pest control business, 75, 80% of the value is in the goodwill, and the goodwill is an intangible asset, which is the customer base. It's not the same as having a $10 million plant with millions of dollars tied up in equipment. So whether you're managing your wealth while you own it, or trying to raise capital while you own it, or certainly strategically planning on the exit, the banks, a lot of times, I think I've seen, they struggle with our business. They love to take our deposits, but beyond that, it can be unfortunately difficult because of the nature of the beast, which is that the primary asset in a pest control business is goodwill, which again is intangible. So working with Morgan Stanley, they certainly understand that, they get it, and by virtue of not being a bank itself, they have different rules and regulations.
Yeah, we can keep this on our balance sheet. We can do tailored lending, so we're not subjective to the same rules maybe that your local bank has.
Kemp, the question we had was, how do you advise PCOs that you work with as to how often they need to meet with their financial advisors, and what type of questions and information should they bring with them to each meeting?
That's an awesome question. I will tell you on a personal note, my family has worked actually with Tim personally for a very long time. There's a great relationship there, and we meet anytime from, I would say, a minimum of once a year to I would say 3 or 4 times a year, just depending on what's going on. It could be what's going on in the market or what's going on with our family. I'm going to let Tim speak to that, but I would say that again, whether it's by Skype or a conference call or in person, to me, one of the most important things is that you have a team, a great advisor, a strategy, that you stick to that strategy, and that, certainly from time to time, whether it's once a year or a few times a year, you're just reviewing it and maybe updating pieces and parts of it. But I think Tim's certainly the expert in that space more than me.
I know that with Kemp and his family, we try to meet 4 times a year. Once a quarter, we want to go out and have lunch. And it really depends on what your goals are. If you are young and you're growing your business, probably once a year is sufficient. But when you start getting kids in college, or you're in a high tax bracket, you want to minimize your taxes, looking at asset protection, all those things, I would say once a quarter is probably a necessity. And here's why. A lot of people feel like they pay us for investing their money. Well, that's about 20% of the things that we do. The other 80% is the other things, as I just talked about: asset protection, lending solutions, all the other things that matter in people's lives. And that's really where we find value. Tim, should I lease or buy a car? How much money should I set aside for college? I have a big tax bill. Is there anything you can do to help? And I'll give you an example of why I think it's important, not only to talk on the phone, but if available, to sit down face-to-face. I came back Friday. I was in New York. We were in Orlando, and Friday I was in New York visiting a client. Here's why we took him out to dinner. Have a client recently I met in D.C. They recently retired, sold a business for $12 million, so they were big clients. And they are now trying to find out how to spend their retirement. And what she did was she got on a board, a co-op board in a condo association, just to kind of give back, a volunteering job. Well, she has a $10 million umbrella policy. Of course, we live in a very litigious society. People want to sue, and I want to try to protect that money that they have. So I asked her, do you have directors and officers insurance? She said, what are you talking about? And I said, if you join that co-op board and you guys try to put in a swing set for the kids in your community and a kid gets hurt there, they will sue you. And she said, I have an umbrella policy. For which my remark was, well, an umbrella policy does not cover directors and officers, just like it doesn't cover if you have employees in your house. Maybe you have a full-time nanny or a cook, etc. So those things, you need other types of insurance. I tell you this story because it's important to sit down with your clients over dinner just to find out more what's going on in their lives, because the more you just listen, the more you can uncover ways to protect them and help them. So kind of a long-winded answer, but I would say you want to sit down probably anywhere between 1 and at least 4 times a year, and usually over dinner.
So Tim eats out a lot.
Too much.
All right, well, Kemp and Tim, that's all the questions we had for you, but I want to thank you again for giving a terrific presentation on a topic that's certainly important to PTOs in all different phases of their career. So I appreciate you guys being a part of our summit today.
Thank you.
Thanks.